Hi, welcome to another episode of 2 Minutes on Tuesday. I'm Sam Miller.
I'm Erica Miller.
And this week we've got a great topic. As you know, we're in an extremely competitive housing market. And so what we want to talk about is a way that we have that can solve a problem for a lot of people. And because we're in a competitive housing market, we've had lots of people come to us, story after story, with buyers saying, Sam, we tried to buy a house using another person and we kept getting beat out. We kept getting beat out in multiple offer situations because we got a house to sell. And so a lot of people don't know that they have options other than just making a home sale contingency offer. There are loan programs available that can allow you to tap into your existing equity of your home to be able to then buy the house you want and then move into it if you like. And then after that, you can put your house on the market and sell it. And we've got ways to keep the costs really affordable, low closing costs. It's a good system. So we'll tell you a little bit about that.
All right, so let's talk about bridge loans. What is a bridge loan? A bridge loan is a sum of money lent by a bank to cover the bridge between two transactions, which are the purchase of one home and the selling of another. So for most homeowners, they will have most of their cash tied up in their current home. Now, when it comes to time where they want to purchase another home, they might have some thoughts like, well, I need to sell my current house before I purchase this one. And this is where a bridge loan will come into play. So you can use a bridge loan as equity of your current house to put down as a down payment on your next house. So you can see where this would be beneficial for these homeowners. Just a few things about a bridge loan is that you do still need to qualify for them, just like you would a traditional loan, and that's based off of your credit score, your income, and your debt to income ratio. Another benefit of this type of loan is that it is short term, typically just about a year, so this gives you time to sell your current house. And one other process that goes into the bridge loan is getting an appraisal done. And this is important just so that the bank knows how much equity you have available to use towards your next home purchase.
Another option that can work for a lot of our clients is a special HELOC loan. And I want you to think of a HELOC loan as a line of credit against your current house, using your current home as collateral for like the down payment to buy your new home. Now, if you have your current home is free and clear with no mortgage, they'll loan you up to 80% of the appraised value of your home to use towards a future purchase. If you have a loan on your house, they're going to take your existing loan into consideration when they do the 80% of the appraised value. So if you've got a $50,000 loan, that $50,000 is part of the 80%. So there's the difference of what you owe and what it appraises at. Up to that 80% mark is what you'll have available to use towards the purchase of the new property. So a couple things you need to know about this type of loan, and they're beautiful. One of which is there's no prepayment penalty, which works perfect because if you're using this loan to free yourself up where you can buy the house you want before you sell your existing home. If you sell your existing home really quick, you can pay it off. If you sell your house in a month, you can pay the whole HELOC loan off with no prepayment penalty. Now, another really big benefit of this loan is instead of having a lot of closing costs to obtain this loan, the HELOC for the lender that we like to use, they only charge $60 a year to have this HELOC. So instead of having upfront monies for appraisals and title fees and recording on the loan for your house, you're only going to have $60. And with no prepayment penalty, if you sell the house off quick, there's literally the chance that the bank could lose money doing this loan because they're absorbing those costs in order to get you that loan. Now, some things you need to know though, you do need to qualify for this loan. So you got to have enough income, established credit, time on the job, or income to qualify like you would in the case of a traditional mortgage. So that's a plus. The interest rate on this loan can fluctuate until the loan is paid off. And for most folks, that's not a big deal because they're only using this as a temporary way to buy the other house. And as soon as their home sells, they pay it off. And basically in a short period of time, 2, 3, 4, 5, even 6 months, the amount of interest you would pay on this loan would be pretty low. So to me, that's a real plus, and it just gives you another option, because one of the things you don't want to do is you don't want to miss out on the house that you really want to buy.
So in an ultra competitive market, much like the one we're experiencing today, you can buy your next home without selling your current home. So there's no chance of selling your house and being without a home.
So if you have questions, if you're wondering, should I buy first, I should sell first, or you're just not sure what to do, give us a call at 740-397-7800. And by the way, this is the last 2 minutes on Tuesday in 2021. And we look forward to coming back and giving you 2 minutes on Tuesday in 2022. I'm Sam Miller.
I'm Erica Miller.
Happy New Year.
Happy New Year.
Thanks for watching.